When we look at the kinds of companies that VCs are investing these days, we're seeing a bifurcation in the marketplace. On the one hand, clean tech is probably the largest investment category now, certainly the most fast-growing investment category. A lot of those companies have been solar, biofuel, and renewable energy companies that require enormous amounts of capital. And I think we're seeing a funding gap now where the venture capitalists that launch these companies are having to look for project finance or strategic investors or even hedge funds that are private equity funds that are used to investing far larger amounts of capital in order to commercialize the product beyond a certain point. And so that's putting stress on the venture capital model at the high end. At the smaller end, we live in the age of cloud computing and SaaS, software as a service. It's just cheaper to start an internet company. And now we have mobile apps companies because iPhone has made mobile applications so popular. Those companies required $50,000, not $5 million to start. And they are apt to turn to seed and angel investors who are happy to write a quick check, and the companies take less dilution, and the founders are quite happy exiting at much lower valuations than VCs are traditionally getting as multiples on their investment, beginning in the millions, say $5 to $10 million, exiting at a $100, $200, $300 million valuation. Those types of deals are fewer and far between, and that's putting stress on the VCs at the kind of low end of the market. Where this ends, we'll have to see, but we're certainly seeing venture funds stretch to accommodate both ends of the market. They're trying to structure deals more along the lines of what angels and seed funds are doing so they can get in on kind of the hot young new companies. And they're also trying to adapt for clean tech deals so that they can avoid getting diluted by the enormous amounts of capital that have to go into those deals.